Alright guys, so as promised, I'm gonna make a video on just a naked chart on the ES and basically how to trade reversal structures, which reversal structures are gonna be your rally, base, drop, or you have your drop, base, rally, which are your drop-ish rally, bull reversal. And I'll explain how to determine the strength behind these levels later. But anyways, we know that these are reversal structures, and we know that reversals tend to take some time to play out, because when you get a move into a rally base drop level, let me show an example here. Okay, so when you get a move into a rally base drop level like this, you know that they obviously take time to play out because they are reversal structures and whatnot. But this, you can see this is a clear drop, base, rally, and the market takes off from this point. You know, we get a rally out of the level, we get a rally up, and then you get the pullback into demand, right? You get the pullback into demand, but notice what happens here. The market pulls back into this reversal structure, this drop-based rally demand zone, but it prints a higher low. See, it prints a higher low above this, right? Which basically would imply that it is a new impulsive move starting, which could be labeled as this, 1, 2 of a different degree. So pretty much what I'm trying to say is that this is a drop-based rally zone right here, and then these take time to play out. So when you see these form, you want to patiently wait for the market to come back into the level and then retest it, right? So for example, I'll go into a daily chart, and okay, so we can go into a daily chart right here, and we can see that the market formed. So on a weekly chart, this is the level. We can see that the market rallied up out of it, and then we can see that it came back in to test it, and it formed a higher low. So an example of playing like a structure like this is when you do see these kind of levels form, you can actually enter on the retest of the level here, and then your risk would be if we break below this pivot low, because inside an impulsive move, if impulsive, wave 2 can't retrace over 100% of wave 1. So it is safe to assume that you can enter on the retest of this weekly demand zone, with your risk being if we break below this pivot low. So what made this drop-based rally demand zone quality over here? What made this quality? Because if you go into a daily chart, you can see that it took out a prior pivot high. So let me delete some lines here. So let me go back on weekly. Where are we? Okay, right here. So there's our level on the weekly. I'm sure I can refine and then show you a better entry, but for educational purposes, I'm trying to show you how to trade these reversal patterns and to determine the strength. So when this level was formed, it was going against this high of 2120. So you could tell that there's enough demand here to actually make a higher high, and it broke above a prior swing high. It broke above this 2120 high, made a higher high, and then it pulled back into demand here. So this is actually a quality demand zone because it took out a prior high. So quality demand equal the zone took out a previous swing high. And then the opposite would obviously hold true for demand. So, for example, when we see these kind of structures here, we can enter on the retracement back into demand with our stop loss placed below here. And that's a drop base rally, which is a reversal structure. So next, what I wanted to show you guys is current price action and where we are at. I just want to plot some levels here. You can see here we have a rally base drop. So if you watch my previous videos, you know how to plot these. There's my box there. And then we have a drop base rally here. And I put 1W. These just show that these are weekly. This is a weekly rally base drop, and this is a weekly drop base rally. So in theory, with this type of method, you typically get the market to move back to demand or supply based on the respective time frame. So here we rallied into a weekly supply zone. So in theory, we should see a pullback to buyers of the same time frame back into this weekly demand zone right here at minimum. So now if I actually go into a smaller time frame, I'll show you guys how I am currently playing this level right here, and how there are two ways to play these types of reversal structures. Rally base rally and drop base drop, they form during trending movements, and you'll notice that that they tend to react immediately. That's because they form in uptrends, and you'll notice that the market reacts to them almost immediately, because they are not reversal structures, and reversal structures consist of retracements to a particular lower high, and the underlying will make a lower high or a higher low. So here's our weekly zone right here, and you can see that we get our test. So we can see that the weekly supply zone is the upper shaded box in this area, and we can see that the market sold off all the way down to this area, and then we got a retest back into the weekly imbalance right here. And then we get our and we get our first potential impulsive sell. You can see that we hit the level. Well, we actually filled the gap right here, right there at the close of the bearish candle right here, and we ended up selling off a bit, and we sold off right to demand right here, right back into a drop base rally demand zone right there. So there are two ways to play this actually. You can take an aggressive short entry at this level right here, and then you can take an aggressive short entry, and then you can cover at demand here, because as we know, if this is a start of an impulsive move, this could be a 1, and then it is a potential 2 setting up here if we can make a lower high out of the zone. Let me dive deeper into a 4-hour time frame. So here is a 4-hour chart right here, and then we have our weekly zone up here. So again, we got our potential first beginning of a bearish impulse rejection out of the weekly supply zone here, right? And then now we are getting our potential retracement back into the level. Now look at what happened as a result of the rejection from the weekly supply zone. It formed a, let me delete this line, it formed a rally base drop supply zone right here at the 2938 level. So we get our original sell here. So two ways to play this. One, aggressive short on test of zone, profit at near demand. Or two, patient counter trend move. Enter on the retracement. This could be 61.8% or 78.6%, or it could just be a level of supply with stop above high formed. So you could have shorted 29.65 on the gap fill, and then you could have taken profit at demand down here, which was 27.77 drop base rally demand, which was the level that we actually took long on the futures market, which was right here. And then I was looking for 290 SPY or 2900 ES, and then you can look for a re-entry up over here with a stop risk. So the idea behind this reversal structure is that if this is a true reversal, then the market should end up falling below here. And the key is that it can print a lower high below 29.65, which means that we have a potential bearish impulse beginning, because if it does in fact print a lower high, this can be a 2, and then we have the move down. So again, rally-based drop and drop-based rally levels are all counter trend, and they do require a little bit more work. Like for example, at this 27.77 demand right here, the one that was last week, I believe, at the 27.77 demand that actually reversed the market. If I went into, let me just label this as 4H for 4 hour. If I went into a 4 hour chart, you could see that it did in fact make a higher low. So again, guys, here's the 4 hour zone. 2 ways to play this. So you would take aggressive long on test a fresh zone. Sorry, aggressive long on fresh test of zone, which would be right here at right there, and you get the move up out of demand, right? And then look what happens. You get your retracement. As always, you get your retracement, but it prints a higher low right there. So again, out of this drop-based rally demand zone as a reversal structure, the result is a 5-wave structure. So you get another, we don't know this at the time, but this is a potential wave 1 impulse beginning, because it is a drop-based rally demand zone. And then we get the retracement. You get your wave 1 up, and then you get your pullback, where it makes a higher low. So obviously, the option 2 to play this would be to, again, wait for a move out of zone, enter on a retracement, whether it's the 50%, 61.8%, or whatever, stop below the pivot low formed from zone. So you would enter on this pullback. Entry. So your entry would be on this pullback for a potential counter trend wave 2 move. And then from there, you can see that the market just kept on going up. You see, then we had continuation, and we just, it keeps making higher lows. Higher low, and then we get a correction here. So drop, base, rally, again, always takes a little bit more time, because like I said, they involve, it's a process where the market tries to retrace and make it higher high, but fails to. And then in this case, the market tried to make a lower low but failed to. So the safe entry would be to let the move happen out of the zone, and then you would look at a re-entry on a pullback with a stop below the low. So for example, in the overnight session tonight, let's say that the market does in fact try to test this level of demand up here, okay? Let's say that we test it. Whoops. Let's say that we make a test at it and we pull back, right? You can take an aggressive short entry at this level and then try to catch the first impulsive move down, or you can be patient, make sure that the level does in fact react. Make sure that the level does in fact react. It goes up and then it comes right back down. Make sure the level does in fact react. Let's say that the level does in fact reject, and then they pull it back into demand here. And then we get a retest of the level here. But on this retest here, it fails to make a higher high. So you get the potential beginning of another bearish impulse beginning. But instead, this would be a completed 5-wave structure. And then you get a potential wave 2 here. The next move that should follow, based on the failure to make a higher high above 29.65, would be a move down, and your stop loss would be above this high right here. Because, so to speak, if this entire move down from 29.65 to 27.71 was in fact a beginning of a bearish impulsive move, then 29.65 must hold. Let me delete these boxes. Too much noise. Or I can just do this. No, remove drawings. So let's say that this is in fact a wave 1, and we are just making a wave 2 retracement up here, and the market does try to hit this rally base drop demand up here. For the pajama traders, you can actually short this if we do get a rejection here and lower high, and this turns into a key level. 29.65 turns into a key level, key high, because if this is in fact the beginning of a bearish impulsive move, and we do in fact print a high below 29.65, this is a potential wave 2 beginning, and we can expect for the downside.